Where do your insurance premiums go? Risk pooling and the community coming together. So when you pay an insurance premium, um, you're basically doing the same thing that people did hundreds of years ago, maybe probably, yeah, thousands of years ago. But it wasn't with a big company. So nowadays it's more commercialized. That's how we normally know it. You're paying money to an insurance company. But there was a time before insurance companies where people still did the same thing as a community that the insurance company does. Right now, you pay a premium, and you're likely paying the same premium that someone else at that same company with the same risk as you is paying. Hopefully, that's what's happening if the insurance company is charging the right premiums for each customer. Well, it's easy for a company to get organized and do it that way, as opposed to um, GoFundMe or something like that. I'm going to pick on GoFundMe a lot, but it's the most popular way to really mimic insurance without calling it insurance nowadays. Um, so, as opposed to something like GoFundMe, where you can just pick whatever dollar amount you want to contribute to whatever that cause is at GoFundMe. Well, that is more primitive and is actually pretty normal and similar to what people used to do before we had these statewide or nationwide insurance companies. So there was a time before these companies existed where if somebody, let's say somebody got sick, the community would come together and pool resources together to make sure that that sick person was taken care of. Um, Not too long ago, I mean, think of your grandmother getting sick, or your parents getting sick, or maybe your mother-in-law or father-in-law getting sick. Hopefully you have, hopefully they have the resources they need to take care of themselves. But if not, maybe you're going to take care of them, or your wife is going to do it, or maybe your kids are going to help out. A lot of times that happens, and maybe you take time off work. Maybe you've got some extra money. You're going to help pay for things. The community's coming together, and then also you have times where people outside the family would get together and pool resources together, bringing in food, bringing sending money, sending other equipment needed for the house. If somebody got sick, something's wrong with the house, somebody died, you're going to have that risk pooling in an informal way, in a non-business or non-commercialized way. That's what people did way back when, and people still do it today. In some cultures, it's going to be very common for them to do that. Well, when that there's an inherent problem with that, right? What if someone dies unexpectedly, gets sick unexpectedly, or what if it's kind of expected because you knew they were sick, they were going to die eventually, but the caring parties or the community doesn't have the resources needed? Well, one example is in biblical times when you could read stories back in I believe maybe like First Kings 4 or Second Kings 4. There's a widow whose I think her husband died, and they didn't have life insurance in the Bible. Okay, so um, her there was some debt, and then the creditor came in, and back in those times, you either had to go into indentured servitude yourself, or you'd have to send your own servants there, or worse, your own children. Well, that was the situation for her. I might be getting that story slightly off, but the point is, her husband died. She didn't have the resources to immediately pay the debt, so she could have either gone into servitude, sent her kids into servitude. But what she ended up doing in the story, you would see, is that Elijah, the prophet, gave her an idea to basically monetize the little bit of oil that she had in her house. So so thankfully she had that. But if not, maybe the community around could help her pay it, but that's not how the story went. But there are cultures, and have been times where communities would come together and make sure that there's food to eat and a place to stay, things like that. Well, some wise people started coming about and saying, "Hey, let's let's find a way to get prepared for this well before something like this actually happened. Let's create a company where we can start pooling resources together every month or every year, so that when someone gets sick, someone dies, something happens to their house, their car, when cars weren't invented until the 1900s, their wagon, their chariot, okay, if something happens, then there's already this pool of funds building, and then when somebody gets sick, something happens, we've got a pool of funds ready to go for whoever that person is." And that's how insurance companies started. Um, so, and obviously, if you do some easy math, the more people in the community that are contributing to that, the easier it is to make sure that there are resources available. The same way that churches want you to give to the church, and mosques and synagogues and so on, religious organizations, they want you to give. Political what do you call it, campaigns, political campaigns, they want you to give, so they have more capital to do more rallies and things like that. um, so the more people that are contributing, to the risk pool, then the less that each individual person needs to contribute. More on that later. So that's what's happening when you pay an insurance premium. You're pooling that money with a bunch of people. Now, if it's just your community and there's no insurance company, okay, I'm picking on GoFundMe again, then the problem is you might only have the people who have access to that link, or the people who know you, the people who know that it's not a scam. They know the person who got sick or who died or who's going on the missions trip or whatever it is. But if you pay an insurance premium to State Farm, dude, State Farm's all over the whole country. So now it's a whole nother conversation whether they're charging a reasonable premium for what you're paying for, okay? But in general, if your car costs $50,000 but you only have to pay $100 a month, that's usually a much better deal than trying to invest your way to $50,000 in hopes that you don't get into a wreck before you reach $50,000. Um, so that's that. It's already tough enough to figure out how to invest well. So paying a small premium each month is leveraging way more money. And so that's how insurance companies started. And so if my niche is life insurance, so just talking about life insurance, um, the younger you are and the healthier you are, the less likely you are to die. So that's why your insurance premium is lower. Um, that's the risk. Now, on the flip side, since you're less likely to die, you might not be as willing to buy insurance. so, so there's probably going to be less 20-year-olds who want to get out there and buy a bunch of life insurance. So the insurance company has to figure out how much premium to charge based on those factors, as well as some other factors too. Now let's keep going. Okay, when you're 40 instead of 20, you're a little bit more likely to die. Maybe some of those people have passed away already. So your premium goes up. Now, if you already have a policy, hopefully your premium is the same. You have a policy and you just pay the same premium for the life of that policy. But if you get a new policy, or you wait until that age to get a policy, you're like 99.9999% of the time you're going to be paying a much higher premium than the 20-year-old, because you're more likely to die. And some of those 40-year-olds have since passed away. So you're more likely to die, so the premium's higher, and there's less people to spread the risk. So your premium really goes up. So we can't, there's less people to contribute to the risk. So each person that's still alive and wanting to buy that insurance has to shell out even more premium to make up for the people who aren't there anymore. And then, of course, when you're 60, that problem compounds. When you're 80, that problem compounds again. That's a whole nother conversation. So hopefully, moral of the story is, if you're buying insurance that's dependent on your age and your health, the younger, the better. So that's how they started. And, back then, people wisely understood that they're going to die at some point. So the only policies they had were policies that covered you your entire life. They called it ordinary life or traditional life. What we know today as whole life. Oh no, I said it. So it was called traditional life or ordinary life. That's what they understood, is at some point you're going to pass away. More than likely, depending on how things go, maybe not more than likely, but you might leave behind some expenses. You want to, a lot of times, especially back then, people didn't have paper assets, okay? Right? Today we have stocks, bonds, and mutual funds and retirement accounts and all these things. Back then, they just had farms and real estate. They had businesses. They had hard assets and no cash to cover things. They didn't have a ton of cash on hand to cover things. They were bartering. People were bartering back then. Agrarian society, biblical society, they were bartering, okay? So when they started coming out with these companies, they inherently understood that you probably need a bunch of cash when you die, whether you die at 20 or you die at 50. And people didn't live very long back then either. So they had ordinary life, what we know today as whole life, and then the value of the policy would grow over time depending on how the company was structured. Okay, there's like dividends and all that, but there was a cash value to that policy, kind of like equity in your house. And the original purpose of that cash value was not to do all this wild, excessive stuff like borrowing against it and arbitrage and, getting a Bugatti and investing into real estate. The purpose of that cash value was to pay the premium later on in life when you didn't want to pay it anymore. Because again, people inherently understood that I'm probably going to die at some point. I should have something that covers me my whole life. But geez, I don't want to be paying insurance premiums my entire life. What if I don't have the cash anymore to pay it? What if they're land asset poor? Yeah, they have the cows and the farm and the house and the business, but they don't have any cash. Okay, so or what if there's just a famine or a drought or something, and their land is not yielding enough crops to produce enough cash? There's the cash value inside the policy. That was the original purpose of that cash value. Now, we just so happen to provide benefits in the tax code where you can get to that money for whatever reason you want besides that, and you can get to it tax-free, okay? But that was the original purpose of that cash value. So eventually, they said, hey, you know what? There are some situations where people, what if people don't really want the cash value? They don't care. Maybe they have enough cash to pay the premium. They don't want the cash value. So the companies came out with a different kind of policy, what we would call today universal life. So if you don't know what universal life is, it's basically it's whole life with no guaranteed cash value. So it's a lifetime policy. There's cash value, but it's not guaranteed to grow. It's not going to grow every year guaranteed for the rest of your life. Some companies might have a small guarantee on it, but that interest rate, maybe there's an interest rate above that that's going to fluctuate up and down depending on what the financial markets are like, what the economy is like. It's not like whole life where it's going to compound on itself every year unless you take cash out. And then also the raw cost of insurance inside the policy goes up each year instead of keeping it a level cost like whole life or term, what we know today as whole life or term. So what that means is that if you buy a policy when you're 20, when the cost of insurance is low, and then later on you're 40 or 50 and the cost of insurance is higher, you might have to put more money into the account. So, but again, if you've been funding it properly, then that shouldn't be a problem. But anyway, more or less, that was valuable to some people because they didn't care about the cash value. Well, if the insurance company is not giving you a guaranteed cash value, what does that mean? That means that they can charge a lower premium because they only have to guarantee the death benefit now, not the cash value. So for people who were looking for a lifetime, well, they only had lifetime policies back then, but people who were looking for a lower premium and didn't care about the cash value, universal life made a lot of sense. It was a better deal than ordinary life. And then when the stock market, I'm trying to remember which one came first, term or variable universal life. I'm probably going to get this wrong, but definitely for sure when stock markets were introduced and you could buy into companies without even visiting the headquarters of the company, when that came out, that's when VULs became popular. I want to say term came out first, actually, before the variable policies. So I should back up, actually. So universal life became more popular also when people started to have more paper assets. When people started keeping more money in the bank and they had more cash on hand, they didn't need the cash in their whole life policy as much. So universal life was fine. Well, okay, so then there were times where people would say, hey, listen, I really don't need any cash value, and I might need a lot of coverage now, but hopefully won't need as much later on because I'm in debt right now, but I'm planning on paying it off because of my business that I'm starting, or I've got kids at home, things like that. So then insurance companies finally came out with term insurance. That's when they finally came out with term insurance. So today, term insurance is very popular, and that's okay because a lot of people carry a lot of debt, and the idea is that eventually they pay it off. So that's fine. Even though you're still going to die one day, so you should get something permanent so you don't outlive your term. That's a whole nother conversation. So many problems with that. But they came out with term. There's no cash value at all, so that means that you're only having to pool risk for a short period of time. So the insurance company can charge a very, very low premium and give a very high death benefit, or protect you with a very high death benefit. That also means that you're likely only you're pooling your risk. You're generally going to be younger when you buy term, and you're pooling your risk with other young people. So that makes the premium very low. The company is also insuring you for a set period of time where you're at a younger age. So ordinary life gives you a level premium for the rest of your life. When you're 20, you're less likely to die. So your raw cost of insurance is lower. When you're 100 years old, you're extremely likely to die. So your raw cost of insurance is very, very, very high. So with ordinary life, it takes that rising cost of insurance and averages it out over time. So we have to include in that average the cost of insurance for you when you're 80, 90, 100 years old, along with right now when you're 20 years old. That's why ordinary life premiums are so much higher, and they're giving you a cash value. Now, here's a little secret about term. Term has cash value because you're still paying a premium. It's just that you don't get to keep it. Everyone talks about, when, with whole life or universal, all these cash value policies. When you die, the insurance company keeps your cash value. And that's not true. Maybe I'll do a video on that later. But with term insurance, they definitely keep your cash value because you never had any cash value to access to begin with. So before you even died, the insurance company kept your cash value, and they kept all your premium when you outlive your term. But anyway, so you're pooling risk at a younger age. So if you buy a term policy when you're 20, 10-year term, 20 to 30, 20 to 30-year-olds are very unlikely to die. So we only, and the cost of insurance only goes up a little bit between 20 and 30. So that average is going to be very, very low. And then any premium you pay, unless it's a quality policy with a quality company that gives you conversion privileges and everything, every single premium you pay is gone unless you die. And that's generally why people don't like life insurance in general. It feels like this necessary evil. If I buy term, I might outlive my term. If I buy permanent or cash value, the premium's so high that I can't invest for anything or pay off my debt. So which one do I get? But nonetheless, you are pooling your risk with lots of different people who you don't even know. And then the insurance company, what's the insurance company actually doing with those dollar bills? That's going to be something for later. But that is a little history of risk pooling and how that concept came to be.